Welcome back to the channel. Today we're diving deep into one of the most talked about dividend ETFs in the market right now, the Schwab U.S. Dividend Equity ETF, also known as SCHD. If you've been watching the market, you've probably noticed how SCHD has been making waves recently. But before you rush to buy it, let's take a closer look at the patterns, cycles, and risks that many investors overlook. By the end of this video, you'll understand why timing matters, why history tends to repeat itself, and how you can approach dividend investing more strategically. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. To understand the present, we need to go back a little over a year. January 2025 was relatively uneventful for SCHD. It was hovering around $27. Nothing remarkable, just steady. But then, in a matter of weeks, things started to pick up. Prices climbed incrementally, $27.50, $28, and before the end of February, SCHD was touching $29. The chatter on social media exploded. Forums, Twitter, investing groups, you name it. Everyone seemed to be talking about this ETF like it was the next big thing. Headlines were popping up with phrases like SCHD is back or dividend stocks are winning again. After years of tech dominance, it was refreshing to see attention shift toward a dividend-focused fund. Then March rolled around. Every year, SCHD goes through something called the annual reconstitution. This is when the ETF's management reviews all its holdings, removes companies that no longer meet its dividend criteria, adds new ones, and rebalances the portfolio. In 2025, some big names were removed, including Pfizer and BlackRock. The impact on the share price was immediate and painful. SCHD fell from around $29 to nearly $24 in just a few weeks, a roughly 17% drop. If you were holding shares at that time, you know how stressful that period felt. Some investors sold in panic, while others held on, hoping for a rebound. Either way, it was a stark reminder of how quickly market sentiment can flip, especially around predictable events like reconstitutions. By summer, SCHD had recovered to about $26, but the lesson was clear. Even solid dividend ETFs are not immune to short-term swings. Fast forward to February 2026, history is repeating itself. SCHD started the year around $26 and has now surged to about $31, almost a 20% gain in just over a month. The pattern is eerily familiar. Investors aware that the annual reconstitution is approaching are positioning themselves early. They're buying shares in anticipation of the reshuffle, expecting weaker performers to be dropped, stronger ones to be added, and the overall quality of the ETF to improve. This optimism naturally drives the price higher. But here's the catch. Once the reconstitution actually occurs, the anticipation evaporates. The mystery is gone, and often investors who bought early take profits. It's the classic buy the rumor, sell the news scenario. Think of it like Apple launching a new iPhone. The stock climbs ahead of the announcement as people position themselves, but when the product is finally revealed, even if it's great, the stock might drop because the excitement was already priced in. Right now, many investors are making a critical mistake. They see SCHD up 15%, 19%, even more, and feel the urge to jump in. It's understandable. SCHD is performing well while major indexes like the S&P 500 are barely moving, and tech-heavy indexes like the NASDAQ are under pressure. It feels like a safe bet, almost a smart move. But buying at $31 just weeks before the reconstitution is likely buying at the top. You're buying the hype rather than the underlying opportunity. Based on historical behavior, a post-reconstitution pullback is very possible. Prices could drop 10%, 15%, maybe even 20%, meaning a purchase at $31 could see shares fall to $26 or $27 in just a few weeks. Yes, you'll collect dividends along the way, but is that small yield worth the potential downside? Some might argue, Icky, but what if this time is different? Markets are unpredictable and anything can happen. SCHD could keep climbing even after the reconstitution. But investing isn't about certainties, it's about probabilities. And probability suggests that, just like last year, SCHD will likely cool off after the March reshuffle. Chasing hot moves without understanding cycles often leads to buying high and regretting it later. The market thrives on emotional investors, especially during surges. Fear of missing out is real when you see double-digit gains, but that fear often leads to the exact behavior the market wants, buying at peaks and facing short-term losses. So what should a disciplined investor do? If SCHD aligns with your portfolio goals, consider waiting until after the March reconstitution. Let the dust settle, watch for a price pullback, and then buy when the excitement has cooled. That's often when the best opportunities appear, when other investors are panicking about the drop. Patience here isn't just a virtue, it's a strategy. Even if you already own SCHD, now might be the time to reassess. If recent gains have made it a disproportionately large part of your portfolio, taking some profits and rebalancing could be wise. Locking in gains and diversifying reduces risk and prevents being overexposed to one asset class at a vulnerable moment. Looking at the bigger picture, SCHD's recent performance isn't happening in isolation. Over the past few years, markets were dominated by growth tech, AI, and high-flying companies, often called the Magnificent Seven. But late last year, momentum began to shift. Investors started questioning the profitability of massive AI spending, and growth stocks faltered. Microsoft, Alphabet, Amazon all saw pullbacks tied to heavy AI investments. When growth stumbles, money flows to value, to dividend-paying stocks, to reliable cash flow companies, the exact type that SCHD holds. This shift explains why SCHD has been outperforming. It's not that the ETF suddenly got better. The market environment has temporarily favored its holdings. What does this mean for the months ahead? In the short term, SCHD could continue to climb, still in the buy the rumor phase. But once the reconstitution occurs in March, a pullback seems likely, perhaps not as severe as last year's 17%, but a 10% correction is reasonable. If the price peaks at $32, expect it to settle around $28 to $29. If it remains near $31, $27 to $28 seems plausible. Looking further ahead, SCHD is likely to provide steady returns over the next year or two. While we may not see explosive growth, dividends will become a more significant contributor to total returns, especially as price appreciation slows. Historically, dividends account for about 40% of total market returns. During boom periods, dividends are less impactful, but in flatter markets, they're crucial. It's essential to recognize that SCHD alone isn't a complete strategy. Diversification is key. That means international exposure, multiple sectors, and different asset classes. A 3 ETF U.S. stock portfolio is not true diversification. Discipline, patience, and strategic allocation separate successful investors from those chasing the latest hype. Avoid emotional buying, overconcentration, and short-term thinking. Consider your timeline. For long-term investors, volatility is less critical, but valuation and diversification remain important. Stop treating investing like a game or trying to beat someone else's quarterly returns. Consistency, risk management, and avoiding major mistakes define success. SCHD is a strong dividend ETF, but it's not a magic solution. Buying it at the wrong time or for the wrong reasons can lead to disappointment. If you practice patience, wait for the right entry point, and maintain a well-diversified portfolio, your long-term results are likely to be far better than chasing the next hot move. Dividend-focused strategies like SCHD are poised to play a more significant role as markets become choppier, providing stability, income, and steady returns. But remember, true investing success comes from discipline, diversification, and strategic timing, not just following the latest trend. So, whether you're already invested in SCHD or thinking about it, take a step back, analyze the cycles, and plan carefully. The market will always offer opportunities, but the ones you capture wisely are the ones that build real wealth over time. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.